Welcome to the Fixer interview series. I'm here with Ken Updegrave. He's going to talk about home equity, reverse mortgages, and a few other things. But before we dive into it, Ken, give us a little introduction and how you got into this business and what exactly you do for people.
Absolutely. Thank you for having me on this morning, Justin. My academic background was in accounting, and I worked for a CPA firm for a number of years, helping businesses implement accounting and human resources systems, and ended up getting into the mortgage business in 2005. In 2010, kind of in the middle of the great financial crisis, I was started doing reverse mortgages and found out I really liked working with the clientele that I was working with. And at the time, it was quite a different product than it is right now, particularly perception wise in the industry. Uh, but I really felt like I was making an impact on my customers' lives and wanted to do more of that. And as I've gotten into the industry in the last decade, it really is a powerful tool that can make a great difference in people's lives, whether they need it as a loan of last resort, which it used to be typically considered, or just from a financial planning standpoint, whereas where it plays into the market the most these days. So that's kind of how I got into the business. I've been doing it in exclusively in the reverse mortgage business now for a decade, and it's my niche, and I really enjoy working with those customers.
Very cool. Now, a reverse mortgage is a backwards mortgage. Instead of me paying a mortgage company every month, one option is they can pay me every month. Is that correct? Can just give the basic types of reverse mortgages. I know there's like the line of credits, but without diving too deep, what are the big picture types?
Sure. The reverse mortgage or home equity conversion mortgage, which is a technical term for it with FHA. Uh, and there's also some proprietary products out there depending upon loan values or home values that you're wanting to work with that are not FHA insured but still carry the same protections. I kind of refer to it as a Swiss Army knife of mortgage products. I mean, it's got an extreme amount of flexibility depending upon how you set it up. If you're just trying to eliminate a mortgage or purchasing a house, maybe a fixed rate option with a lump sum draw is the right option for you. It has a variable rate option as well that works very much like a home equity line of credit where you can take money out on a recurring basis on monthly payments if you wanted to, or just as you need to take money out, or just to have it in a standby state to be able to support other assets and kind of be a shock absorber for a lot of things that might happen in your life as you age. So,
So, yeah, no, that makes sense. Um, so I may have a client that has paid off their house, is in retirement, and is cash tight. And they can basically come to you and say, hey, I need a reverse mortgage where we just need a little bit extra income out of our home equity each month just to help pay all the other bills. That's one option. Another option could be someone sells their house and says, hey, we're going to downsize or upsize. And they may put half the money down or three-quarters of the money down, but have this reverse mortgage where there's no payments either way, and the reverse mortgage company ultimately owns a piece of the property over time where you don't actually make any payments. Is that
well, they don't ever really own it. It works just like any other mortgage. You have maintain title to the property, and we have a lien against it. But the
okay?
lien is an increasing lien instead of a decreasing lien when you're making payments on it. So, typical amounts that they can borrow it's dependent upon age and interest rates. But currently, it's about anywhere from about 50% at age in somebody that's in their mid to late 60s. If they're in their mid 80s or above, they have access to about 75% of the equity in the property. And that's based on whatever the appraised value or sales price of the home is.
Okay. And then, so you might have those two types of clients. I might also have a client that I think you alluded to it, might be using it strategically where they draw out from it when they want to, whether they they use it as a, whether it's an emergency fund or a backup if they don't want to take out of the market when the market's down. And they basically have this line, like I guess I refer to it as, it's like a credit card against your house, but it's not credit card interest rates, it's home loan interest rates. So it's not a mortal sin. It's just you
Right.
borrowing strategically against the house in that sense. Um, and I know
Yeah,
there's complexity on how that grows over time, or you have the ability to borrow more over time.
I just was showing an example to a customer the other day that was thinking about utilizing it from a strategic standpoint. And one of the strategic standpoints we look at is, if you've got other assets out there that you're working with, the retirement portfolio, qualified accounts, things like that, what happens there? One of the biggest risks for those people as they enter retirement is sequence of return risk. What happens if they have a down market?
Yeah.
Well, this, like I said, could be a shock absorber for that. So, if instead of drawing from their portfolio after they have a down market, if the following year they draw out of their home equity, it ends up, if when you look at it, depending upon when those sequence of returns happen, but if that only happened 4 times or 5 times during a person's retirement years, they tend to end up in a better overall position because their portfolio is larger going forward. And even though they've got a mortgage on their house and their equity in the house isn't quite as large, the difference in the portfolio and the remaining equity in the property tends to be quite large. I mean, if you're doing it with somebody that has a $500,000 portfolio and a $500,000 home that they're utilizing on that, the difference over a period of 30 years magnified could end up being $1.5 million difference in what their final estate could be for their heirs.
No, that makes sense. Yeah, I mean, obviously, if the market takes a big dip, it's more likely to have a outperforming year in the coming years, and you don't really want to be drawing out of that investment account until at least it's recovered, ideally. And this gives you that shock absorber, like you mentioned. Um, so what are the limitations? You have to be 62 years old to get a reverse mortgage. Do you have to have good credit or income, or what restrictions are there to the person considering it?
So at least one of the people has to be 62 years of old. If it's a couple, if it's a single individual, they got to be 62 years of age or better. It's got to be their primary residence. It needs to be a home that you're going to want to reside in for quite a number of years, because the cost on the loan are going to end up being higher on the HECM product because it's an FHA insured product. And that FHA insurance basically means that no matter what happens to the home value, you'll never owe more than the value of the home when the loan gets paid back. So if you had $1 million in another account, they can't go against it with recourse like they could with another loan if you were upside down on it. And then what we look at from a credit and income perspective is we want to make sure that the borrowers have the ability to pay their taxes and insurance. We don't want them to go into default because they can't pay taxes, insurance, or HOA do. So we look at that, take that into account, take into account what the expenses of operating the home are, and their other debts. And then we want to make sure that based on the household size, that they have enough residual income to be able to live off of after all their other expenses are met. Tip for most of my clients, we can qualify them just based on Social Security income unless they have a lot of other debt. Credit wise, we're looking to make sure you've made your home payments, anything that's related to the home, be it property taxes, homeowners insurance, any current mortgage, paid current for the most part over the last 2 years. We want to look and make sure that other installment debts are being serviced well, and that you don't have a tremendous amount of late payments on any kind of revolving debt. It's fairly flexible in that we don't look at credit scores directly. What we're looking at is what's actually on the credit report when we're qualifying somebody. And then, like I mentioned before, it's based on interest rates and age of the youngest borrower, how much they have access to. If they're purchasing a home for a downsize or a relocation, what that means is we'll figure out how much we can lend, and then the balance of the equity would need to be brought to closing. But for a lot of people that I'm working with, they're selling a home in another location that they've got a lot of equity in, and they may want to reposition that equity into other assets for them to be able to have a better retirement lifestyle, or plan accordingly for what their wishes are going forward.
Yeah. No, that makes great sense. So the basics are you have to be 62, and it's a way to use your home equity for either income or just not have to make the payments, so to speak, where you just have this loan that the interest rate, instead of paying the interest rate, the interest payment just gets added to the loan each year, and it can never be worse than the equity in the house. So you're never gonna wake up and you're 90 and you have zero equity, and now you owe the mortgage company extra. The worst case is you've lost the equity in the house over your lifetime and not had to make payments.
Yep, that's basically it. What we find on that, when we look at that, for the most part, with the way the loan's structured nowadays, the costs are lower on it now ongoing. They've increased the cost to get into it a little bit to offset the ongoing costs on it. But when we look at an amortization schedule and see it, even if you take a full draw, like you're purchasing a home right now on it, just for example, let's say we're doing a $400,000 purchase, and you're borrowing $200,000 of that, using this product to do it without any kind of monthly payments. If the interest rate was 5% on the borrowed funds, you're adding $10,000 on an annual basis to the loan. If it's a 4% or $400,000 home, if it appreciates at 3% or better, you're adding $12,000 to your equity. So you're actually still gaining equity at a smaller rate, but you're not having to make any kind of monthly payments on it. And what we find in talking to customers that are in the retirement stage or in the retirement planning stages they are more concerned at this point in their life with managing cash flow and managing liquidity than they are with managing the equity in their home. And they finally come to the realization, this might be a little bit of a analogy that you might be a little too young to understand, but they pulled off the vinyl covers that they had on their seats so that they could enjoy sitting on the seats instead of preparing it for the next people that own it.
There you go. I get it.
Yeah.
No, that makes sense. That's a good analogy. Okay. Well, I don't want to dive in too deep, but if people have an interest in getting a hold of you and asking questions or understanding a little bit better, if it makes any sense for them, how should they get in contact with you, Ken?
Probably the easiest way to get in contact with me is to give me a call on my mobile phone, which is 919-412-8389. They also can email me at ken@kenupdegrave.com.
Okay, great. Thank you, Ken. I'm Justin Struble. I've been here with Ken Updegrave talking about reverse mortgages, and I am with BSG Advisors. We're not brokers, we're fixers.